Stocks continuing to sell off after that hotter than expected inflation report. Let's get straight to New York Life Investments economist and chief market strategist Lauren Goodwin for how she's playing it. Welcome. It's good to see you. What are you doing with this market today?
I think that we will look back on the last couple of months, Scott, and know for certain that this Fed pivot rally we've been enjoying was just a step towards what's increasingly becoming in the data a much clearer binary outcome for the markets. Either the impact of Fed hiking so far is going to catch up with us sooner and we'll see economic growth slow to a mild recession sooner rather than later, or we'll see some firming, overheating. And that's what the data points a little closer to today. I don't want to overstate that point, but I think the market is making that risk much more clear in price action.
So you're betting on an overheat. Now, what does that mean for your calculus on what the Fed does?
Our base case is actually that we're going to see an economic growth slowdown sooner rather than later. But that base case points to the Fed doing essentially exactly what it said it's going to do, which is wait until June to, at least June rather, to start cutting interest rates. We're looking at a price environment where price pressures are re-broadening. It's just one report. We'll have plenty between now and May and June to clarify the picture. But because we're seeing prices paid pick up in the services sector, in the manufacturing sector, and we're seeing small businesses in the NFIB report today say that they're still looking to pass on higher prices, that's painting a sticky picture for the Fed.
But if I told you we're going to get a June cut, let's just say that's the ribbon gets cut, they start cutting interest rates at the June meeting. Why shouldn't I be optimistic still about the stock market?
In a word, because we've already seen and enjoyed a lot of the valuation uptick that comes from a gradual cutting cycle from the Fed. If we know for certain that the Fed is cutting in June, then really what investors should be thinking about is the oversized cash allocation that we've seen investors take on over the last year, 18 months. How do they lock in higher rates now? Do they move into short-term municipal bonds, short duration, high yield, or other elements of credit in order to lock in what would then in that case be declining Treasury values on the front end of the curve?
See, you've been talking about credit opportunities almost every time that we've been speaking, including the most recent. You just mentioned it there. You still favor credit plays relative to equities?
I think investors have to be balanced. As I mentioned, this is a binary market. We're not likely to see a clear signal from equity until, frankly, economic data turn to the downside. Even if we get upside data from here, I don't think we're seeing the equity market do anything particularly directional. So that's an environment where you have to own mega cap tech because that's where there's growth and strong earnings, free cash flow. You also might own some of the potential beneficiaries of those trends, the digital infrastructure, et cetera. But that's a relatively narrow opportunity set for adding incremental exposure at this time. When it comes to adding incremental exposure, we're looking at shaving off of equity and, yes, operationalizing it in credit where we see yield as a better risk for the return for the risk. But
you're also making the case, just like Richard Saperstein was, who was just with me, that narrow is okay. And narrow is the play. And that maybe the 23 playbook is the 2024 playbook for all the reasons that you suggested.
I think that very well could be the case. It's not clear to me that narrow is the play, but narrow is what's happening. Narrow is a late cycle economic environment where large cap and profitability and free cash flow are more likely to benefit over time. There are going to be moments in the next couple of months, I'm certain of it, where we see enthusiasm and a broadening out in market performance. But with inflation looking sticky as it is now, with the same type of risk playbook that we've seen in 2023, I think that 2024's playbook may look similar again until we see a decisive break in the economic data.